This segment sponsored by Foster Financial. Welcome to Money Monday, where we provide you with holistic financial advice from Caleb Doan, the Vice President of Foster Financial. Good morning, Caleb.
Good morning.
All right, how's it going?
It's going pretty well. A little colder outside, but it's all right.
I know. Hit us with a little cold front here.
Yeah.
Okay, so today we're going to talk about the market and how it's at an all-time high.
Yeah.
So is that correct? What does that mean exactly?
Yeah. So I mean, typically the index that a lot of people track is the S&P 500, and it's hit many record highs this year. So currently at all-time record highs. And when that happens, sometimes people are kind of wondering, do I need to make any changes to my accounts? Is it something I need to react to?
Right.
And typically, the default is when the market is actually going down, a lot of people say, I need to get in there and I need to make changes. I'm worried about it and I want it to stop losing money, essentially. And oftentimes that's actually the time where you're supposed to stay the course, right? You're supposed to kind of keep things status quo most of the time and allow it to recover if the market were to recover. When the stock market is going up, a lot of times people's default is, hey, I'm just going to leave it where it's at. It's doing good. I'm not going to go in and mess with it. And oftentimes you actually should go in and maybe rebalance or kind of make some changes. So those were kind of a couple of things I thought we could talk about today.
Yeah, and especially with people's 401ks, as you said, like how does it impact them? So what should people do in the midst of this change for their 401k?
Yeah. Well, the market has gone up over the last 2 years. 2023 was a really big year. 2024 was a really big year. And there's kind of a couple things that have happened in people's 401ks over the last couple of years. First would be, if 2 years ago you were invested at, let's say, a 70-30 split of about 70% more growth, more equities, about 30% conservative bonds. Well, the equity side has grown a lot faster than the bond side. So maybe you were 70-30 a couple of years ago. Now you're probably closer to 80-20. So you're, one, more riskier than what kind of you intend to be. And also, you're 2 years closer to retirement, right? So time has passed. You're closer to retirement now. And for most people, you want to start reducing risk the closer you get to retirement.
Okay, so how would one go about reducing that risk?
Yeah, good question. Within a 401k, the tough thing is there's not a ton of great options. So within a 401k, typically you've got, maybe 20 different mutual funds that you get to choose from. Of those, maybe 3 of them are more kind of conservative bond funds.
Okay.
And that's typically what you can do in a 401k is you take a portion of the investments out of that equity, out of that growth side, kind of pull that gain off the table and put it into that bond side. Maybe you take 10% and move it over or something like that. So, that's one option that you have in a 401k. The kind of downside of that is that bonds historically have significantly underperformed equities. They've underperformed that growth side. So if the growth side is averaging, 8% over the last however many years, the bond side's probably averaging 3 or 4%. And so it feels like you're kind of giving up a lot to add some of that kind of conservative weight to your portfolio. So, within the 401k, there's kind of limited options there. A really great option that people have is if you have a 401k from a previous employer where you're no longer working, or if you're over 59 and a half at your current employer, you typically have the ability to roll that money out of the 401k into an IRA with a financial advisor. And so, that can be a really great option because if it's with a financial advisor at Foster Financial for all the IRAs that we manage, we have access to really the entire world of investment options. It's not just the 15 or 20 mutual funds. We can get in interesting investments like ETFs, different types of bond funds, individual treasuries, buffered funds, which we've talked about before. There are a lot of great ways that we can reduce risk, but maybe still have some of that upside participation.
Okay. Well, that sounds good. Good to know. With these interest rates continue to fluctuate, so good to know how to best manage them and benefit our finances. So thank you, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, you can contact them for a complimentary consultation. We'll have their phone number listed below, and I'll see you after the break. This segment sponsored by Foster Financial.